Something that gets tossed around quite a lot is this idea of taking profits in crypto, but how are you supposed to do that if the price hasn't recaptured the original buy price that you paid when you first made the investment? This question has been coming up a lot and we've covered it a few times on the show. I figured it was worth making a dedicated video for it. This is a hypothetical scenario with numbers that I'm just going to make up for the sake of conversation. I'll give a disclaimer at the end of the video, but in the interest of time, let's get right into it. Let's pretend that you made an initial investment into ETH at $2,800 and you bought one of them. And then the price fell to $2,400. You got a little bit nervous and you decided to do what we call de-risking, which means take some of your money off of the table in case it falls down further, and you sold half. In doing this, you've done two things. One, you've now changed the makeup of your portfolio to be half of an ETH and $1,200 in cash, and you've also netted a capital loss of $200. Let's say again, hypothetically, that the price is now down around 2,000 and you've decided to re-enter with some of this cash that you now have on the side because, you felt like buying the dip. You spent that $1,200 that you had in cash and you've now acquired 0.6 ETH, increasing your holdings back up to 1.1 ETH now. So far, what we've done here is expand our position in ETH to 1.1 from 1, meaning that we've added some to the position. We've lowered the cost basis at which we acquired it, meaning the price that we paid on average to buy this investment. And we've incurred a capital loss of $200 that we can now use against some future gains to offset our tax obligation. Let's say hypothetically now the price jumps back up to $2,400 and you've decided to take some profits. So you sell again some of your holdings. You decide to sell 0.5 ETH at a price of $2,400, giving you $1,200 in cash again. It's worth noting that now we are going to incur a capital gains tax obligation. So we have to at least write that down. But remember, we've got that capital loss earlier that we can use to offset this. There are some rules. I wrote down here the acronym FIFO, which stands for first in, first out. Put a pin in that one and we'll talk about it later. It's not worth derailing the whole video for it. To refresh our memory, we now are holding 0.6 ETH and we have $1,200 cash on the side. So we have added some profit to the table here. We managed to capitalize a little bit on the volatility of this asset, even though we have not yet recaptured that original height. To continue the hypothetical, let's say the price crashes again, right? We've been seeing this yo-yo effect going up and down. Let's say the price goes to $1,800 and you decide to buy a little bit more. You spend $900 to buy half of an ETH back at a price of $1,800. No taxable event, this is just a purchase. As it stands now, we have a cash reserve and we have re-expanded our holdings back up to 1.1 ETH. To keep the pattern going, price increases again and we decide to de-risk and take some profits off of the table. This adds $1,150 to our cash reserve while still keeping half of an ETH, or 0.6 of an ETH in our position. Remember, now we've netted another gain of $250. We can no longer offset this tax obligation. So we have to remember that we made this profit here because that capital loss we incurred on the first trade was used to offset the second trade. And now we are actually in real profit. So we can't claim that anymore. I gave one more example here of another trade. Take your $1,150, spend $850 of it to buy back another half of an ETH if it drops back down again to a new low. Once again, expanding our position of ETH back up to 1.1 while now still having cash reserves on the side. But really, this could just either go on forever or you could stop at any point. The disclaimer here is that this is a hypothetical meant to display one method that you can use to still take profits on investments that are hyper volatile, even if you never recapture the original price that you paid for it. I do not know what your personal financial situation is. I do not know what your investment plan is. I don't know what your risk tolerance is. I don't know how much money you have. I don't know how much money is invested for you. I don't know how much you can afford to lose. I don't know anything about you. And so me just giving this kind of blanket advice is really not helpful to everyone. Again, really what I wanted to do was paint a picture that you can use to form your own investment strategy. Really, the goal here is just to sort of help demonstrate that even if you never recapture something, you shouldn't feel like you're 100% locked into something forever. This stuff is volatile. It swings around. And we talk all the time about taking profits, and you're allowed to participate in that even if you're not all the way up. This was more just a convoluted math problem to show you how this stuff works when you really break it down and think about it. I have no doubt that some of this is confusing. I have no doubt that some of it is overwhelming. If you have any questions, please feel free to ask. I do run a free Discord community that you're more than welcome to jump into and ask anything that you want. There's a whole community of learners in there at all different levels of experience, and they would love to help you wrap your head around this stuff if you're brand new or just feeling stuck, feeling overwhelmed, or any of the above.